Our goal is to get you to make informed decisions about your own finances. Taxes, because there are so many different types of taxes that we talk about when it comes to this whole thing. So you would hear about payroll, you would hear about sales taxes, you would hear about T2, corporate income tax, you would hear about personal income taxes, and you would hear about dividends and all that. And people are like, okay, but what is what? And most people don't know any of that. So I want to focus on breaking those down so that hopefully you have a little bit more clarity about what you're supposed to be filing and what are the dates that are important in all of this. And then we can go into questions that are more specifically relevant to that. For payroll taxes, everybody who has an employee has to do payroll taxes. For most of you, you are the only employee in your own corporation. So you have to do payroll taxes for yourself. And that has to be done by, so this could be for both corporations or self-employed if you have an employee. So if you have a corporation, then very likely you're the only employee in there. If you're self-employed, you do not consider yourself your employee. But if you have hired somebody in your family or a friend or somebody else to be an employee in your thing, taking care of maybe administrative stuff, and they're your employee, then you get to do payroll taxes for them. Now, there are different requirements depending on, like, if you have to do that like this, there's more complexity now into how do you set that up and all of that. It's just, now, once you have employees, you have to withhold taxes from every single person and contribute your own share as the employer. And then within the month, let's say in the month of January, you paid your employees salaries. If you're paying somebody, let's say you're paying somebody $100, they don't receive $100. They receive less than that in their paycheck. That's because you have withheld taxes. As an employer, you get to add some taxes to that, and together, the portion you deducted plus what you contributed is what is called as the deductions at source, DAS, that you see here. And you're supposed to remit that to the government by the 15th of the following month. So anything that was withheld in December should have been remitted to the government by the 15th of January. Now, how does this relate to some of you here? Those of you who have corporations and you paid yourself throughout the year and you didn't declare that as a salary or as a dividend yet because you don't know what to do and it was probably just a loan. I mentioned this last week. You're already late to declare what was taken out in December. Between January to December of last year, you're already late because it should have been remitted by the 15th of the month of January. So if you had employees, at the end of the year, you're supposed to then prepare a T4 for them. That if you're currently an employee, you receive that from your employers. You don't even think about it. But now when you are the one that has those employees, you have to create it. And that's a T4 summary and the slips for every single person. And the due date for that is the last day of February. So we still have 1 month and a few days to be able to take care of all of that. Now for sales taxes, the different types across Canada is GST, QST, HST, and PST. Who does this affect? Individuals and corporations. So if you are a corp or if you're self-employed, it affects you for sales taxes if you are registered. Now, most of you only have services that are not taxable. Nursing in general is not taxable, but it depends again. If you're doing something in addition, then we need to see if that is a taxable thing or not. Like, for example, some of our sisters here have businesses that are run within their corporation. So you might be selling scrubs, you might be selling something else, right? You might have to be registered for sales taxes. And if that's the case, you have to collect sales taxes and you have to do a reporting based on the frequency that the government assigned to you. So that could be monthly, could be quarterly, could be semi-annually, or could be annually. Once you registered, you got a document from the government letting you know what your filing frequency is. And you have to then be able to do your record keeping in a way that you're able to remit the taxes at the time that it's supposed to be done. Now, onto the next part of the type of tax that we have is the corporate income taxes. Corporate income taxes is only for corporations. So if you are incorporated, you are a corporate. Like if you are incorporated, then your business is a corporation. And that business has to file its own corporate income taxes. Across Canada, it's the T2. For those who happen to be in Quebec, you also file a CO17 along with your T2. Now, this one is a thing that's completely new for a lot of people. So the corporate taxes is the thing that is completely new for a lot of people who are just getting into this travel nursing and they have incorporated their businesses. This is the part that is like, I don't know what that is. It has its own really important dates that seem to be the most complicated, but once you just take the time to understand it, then you know for you. Now, when you have a corporation, if it's your first year of incorporating, your year end, you get to choose the year end. To choose your year end, it's within the 53-week period from the date of incorporation. So if you were incorporated in December of 2022, for example, your year end can go all the way to the end of December of 2023, like not more than 53 weeks from the date of that incorporation. You need to look at your statement or your articles of incorporation or your incorporation documents to see exactly what date is indicated there to know the date that you can put as your year end date. Again, this is the max you can go, 53 weeks. It doesn't mean you have to. If you choose that December 31st, if you choose that, you can choose any date as your year end from the date of incorporation, but the max you can go is 53 weeks. And that's why there's something called a 53-week rule in the year one. But once that date has been chosen, then that becomes your year end date. And every year after that, like every anniversary date from that date becomes the year end date for your company. Now, your payments and your filing are in relation to that date. When you do your corporate income taxes at the end of the year, you have 6 months from the year end date. I'm going to use a very simple date. Let's say December 31st is your year end date. The due date for you to file your corporate income taxes is 6 months after the year end. So December being your year end, you're supposed to file your taxes by the end of June of the following year. However, if you had the balance due on that year end, which is December of 2023, if you had the balance due, the government expects you to pay that balance due within 2 months. So even though it's not yet a deadline for you to file 6 months, they expect that if you are going to owe them when you file in 6 months, they expect that you should have paid them within 2 months. That's where it becomes a little bit like, how am I supposed to know what I owe you if I haven't done my taxes yet? Like, they don't care. If your year end is December, by the end of February, if you were supposed to pay taxes, you're supposed to be paying the taxes by then, even though you don't have to file technically until the end of June being your due date. So what I would generally encourage people to do is you don't need to wait till the end of the 6 months to file. Like if you're doing your bookkeeping on an ongoing basis in your corporation, then by the end of January, technically December bookkeeping is already done. And so February, your taxes can already be prepared and filed, and then you're much early for the filing date, but you're on time for your payment date. But if you don't know what your balance is, I mean, it's not the end of the world. Ideally, you want to pay ahead in time, because if you don't, then when you get to pay them later on, they're like, oh, you should have paid us this money 4 months ago. Now you're late, so you got to pay us interest and penalties on the late payment. It's just something the government does, and there's not much we can do to change that. So we need to know what those dates are, so we're not wasting our money and paying things that we could avoid. Now, on the personal income side, who needs to do this? Everybody. We've all been filing personal income taxes from the day we became Canadians, so whatever. So this is not new. This continues to happen even though you're filing income taxes for your corporation. You still have to file your personal income taxes. The important dates for this: remember, if you want to reduce your taxes as an employee, RRSP is one of the only ways that you have. There are other ways to reduce your taxes, like when it comes to when you're being self-employed, like there are other ways. But if you're an employee, unfortunately, there are very few ways in which you can reduce your taxes, and those become things in like tax planning. That becomes a different conversation. So this conversation is about making sure you know the dates that are important. Last day of February is the deadline for putting an RSP that counts towards the prior year. April 30th is a deadline for you to file your taxes of the prior year. June 15th, if you happen to be self-employed, June 15th is the deadline for you to file the taxes for the previous year. So year ended December 31st, 2023. Self-employed people, you have all the way to June to file and you're not going to be late. But however, again, if you owe the government, they expect you to pay them by the 30th of April, excuse me, even though you don't technically know whether you owe them or not. And if you don't, then there's interest and penalties on all of that. So these are a lot of dates to know, but you need to find a way to know them or create some reminders for yourself or have someone who's taking care of all of this for you so that like it doesn't stop you from having to know them, but at least you're aware of what is to come. And so things don't sound too overwhelming or too confusing for you. Now, this one is one that is completely new to a lot of people, which would be the dividends. The T5 is a slip just like the T4s that you get. Like think of it in like when you have payroll, you're an employee, you get a T4 slip, which is going to indicate your pay for the whole year. If you were a contractor with somebody and you were self-employed, maybe they gave you a T4A, maybe not. Not everybody gives a T4A. If you have your corporation now and you took out money from the corporation, which you're not going to report as salary, and it's not going to stay there as a shareholder loan, and you're deciding to declare it as a dividend, your company has to produce a T5, which is a dividend slip. And who does this relate? Is the corporations that have to issue it to their shareholder. So for example, IDA has a corporation called IDA Incorporation Inc. And IDA pays extra $10,000 to herself just for the sake of it. My corporation has to issue me a T5 for that money that I took out. And if the corporation doesn't issue it, like the government doesn't always know, but they can. And if it doesn't issue a T5 and I file it, like if it eventually issues a T5 and it's late, like the filing date is the last day of February, you don't pay anything extra for filing the T5, or you don't pay anything extra as a company, right? You just need to be aware that dividends don't get deducted as a part of business expenses, because a dividend is a distribution of profit. So think about you build $100,000, your expenses come down to whatever it is, and you have a profit in the company of 40 or 60. You decide to take part of that money for yourself. It doesn't count as an expense in the company, it's a distribution of profit. So it doesn't reduce your corporate income taxes, but when you put it in, once you receive that, it's going to add your personal income taxes. Now there's a whole planning around, should I take a salary or should I take a dividend or should I take a mix of that? Those are things that when you sit one-on-one with your accountant, they get to help you to make those decisions. But overall, in terms of like understanding the dates, you need to know that the last date to file your T5 for the dividends that you issued from your corporation is the last day of February.
Actually, when you're talking about this dividend of a thing, is it a must? Like, I am incorporated anyways. So is it a must for you to have a dividend or to buy a dividend or to, because like when you are talking about dividend now, I was wondering, am I supposed to be buying dividend, or am I supposed to be, or is my company supposed to be buying dividend, or what? So can you just throw more light on that, please?
Okay, so dividend is not something you buy. A dividend is the money that it's like a salary, but it's not. It's just the money that your company pays to you as the owner.
Is it different from salary that you are paying yourself? That you are deducting and paying yourself from your corporation?
It is different.
Okay.
It is different in the context of what people generally understand here. To them, it's not different, but it's
Mm-hmm.
very different.
Mm-hmm.
Because when you think about, like, you have been an employee to other people before having your corporation, you've been an employee to somebody else, right?
Mm-hmm.
That person, when you went and you did your hours of work, they paid you a salary. They gave you a paycheck, you got your salary, that's it, that's all. But the person who was your employer or who owns the company doesn't need to work in that company. Just for the fact that they own the company can give the money anytime, according to their shareholder agreement. That money that the company is giving to them is a dividend. Now, in our case here, because we are both the owner and the employee, we don't seem to think there is a difference between the company paying us as an employee versus the company paying us as the owner of the company. So what a lot of people I see doing is that there's money sitting in their business bank account and they take it out. That's it. They just take out the money. That's what I've seen with a lot of nurses, right? Because they don't know, a lot of travel, because they don't know what to do actually. So that's why when it comes to the end of the year, if you haven't been working with an accountant all through, when you come to the end of the year, what was sitting down with you to look is like, hey, Omo, you took out $130,000 from this company this year. We need to make this money has to be reported somehow. How much of this does it make sense for us to classify as salary? And how much does it make sense to classify as a dividend? Because you are the owner and we can make those choices with you.
Okay.
And now when we're looking at that, it's a matter of looking at the overall tax situation and see which combination of salary and dividend is going to lead to the least amount of taxes overall for you and the company overall. That's what we're able to, in like quote unquote tax planning, that's what we're able to look at and see, like, how do we make sure that, number one, the taxman gets his money, but the taxman doesn't get more money than he's supposed to take. Yeah. And because a lot of people are not paying attention to that on an ongoing basis, when they come to see us, they're surprised at how much it is they've actually taken out of the company, and the fact that that money, first of all, was not your money because it's a corporation, right? It's your company, but it's not yours. Like, so you're taking money out of the company, and this company has to say, I paid Omo X amount of dollars from this structure. And there is a boss up there who wants to know that how much that company paid to the person who owns it.
So that means that I'm accountable to the company.
Yes, you're accountable to the company.
Okay.
Exactly. Okay.
I was just going to say that another way that I interpret dividend is like profit that is made by the company, and being the owner of the company or being a kind owner of the company, you want to share it to these many people. So it's technically not pay. It's like when people work for a company and then they have a bonus check of $200 that came from the company because they made more profits this year. So they are just giving you guys like a share of the profit. But technically it's not a pay, but then the employees still have to pay taxes on top of it. But then the company, the incorporation sees it as a dividend in order to write off tax. So that's how I see it. Am I correct?
There is a slight correction that needs to be made there. So it's correct in the sense that you're seeing it as a quote unquote bonus. But what's not correct in that is bonuses are deductible as expenses in the company, but dividends are not. Later they decide to pay out bonuses of $10,000. The company now only gets to pay taxes on the difference because those bonuses are part of the business expenses. On the other side, when it's a dividend, the company has to pay its taxes first, and then whatever is left gets distributed to the owners of the company as dividends if they want to declare a dividend. And however, dividends, individuals pay less taxes on dividends than they do on salary.
Right. Okay. Yes, that makes sense.
It's usually more beneficial to take a dividend than to take a salary. But again, it depends on your individual situation, because dividend doesn't count as income in certain situations. Not for the taxman. It's always income for the taxman. But to the bank, it doesn't count as income when you're trying to see how much RSP room do I have, or to qualify for a mortgage. Sometimes it doesn't look at dividend as an income. So now it's like, what's your situation like? Do I need to show income, or does it not matter and I just want to make sure my taxes are lower? Then we start to look at things like that. And that's where it's important to then, when you're meeting to discuss with you, to have your financial plan, you're meeting to discuss with your accountant or with your financial planner or any of that, you are having like a holistic conversation, like, this is my situation. Because in general, we want to save your taxes, but how is saving your taxes taken away from your other financial goals that you have? With saving your taxes and you can't buy a house when you intend to buy a house, then we're not helping you. There's a question here. Can you as an owner take a dividend, a salary, and a bonus? Yes, you can. A bonus is actually considered as employment income. It's part of employment income. When you own a company, there are only two ways to take money out of that company. Like, that is like a permanent taking out of the company. It's as a salary, like employment income, so bonuses, salary, any of those that would end up on your T4, or a dividend, which will end up on the T5. And so I think that's where the question came up of like, what about a shareholder loan? Yeah, it's temporary, because a shareholder loan, you can loan money out of your company, but it's a loan. It's either going to be paid back, in which case it's going to cancel itself, or it's going to have to be issued out as a salary, in which case, like, you're going to pay taxes on it eventually, and that kind of thing. So it's all our answers. Like, I know people don't like the answers accountants give, but it depends. It's the most logical answer we can ever give you, because there's no one size fits all. Like, oh, I come to you and say, my eye hurts, does it mean I need glasses? You're gonna say, well, it depends. What's wrong with your eye? And you would have to diagnose to see what my problem is. It's not because when people's eyes hurt, it means they have eye problem. It could just be something got into my eye and I just need to take it out, rather than needing eye surgery or something. So it depends. And like, that's like a general answer that we'll give for a lot of things, because you need to meet your professional to get to know for your own situation what's applicable.
Yeah, that was a really good one there. And not just that people's cases, sometimes not just that people's cases vary, but even you as an individual, your situation last year as a travel nurse changes the moment you stop being a travel nurse and you become an employee. So even individuals themselves, it changes every year and every time. And trust me, the same accountant you use as your employee might not necessarily be the same accountant you use as an incorporation. I'm a victim of that, where I let somebody run my taxes, and she wasn't certified to do incorporation taxes, and I had to pay huge amounts of tax because she did my tax as an employee. So I was making all of the money that was going into my incorporation. It was pretty much seen as my individual amount of money that I'm making, and I'm not paying taxes on them. So you can imagine how much the government charged me for making over hundreds of thousands, right?
Excel is like the easiest place to go, especially if you're a solopreneur. But if you're a corporation, because you need to also show your balance sheet, like you need to have a trial balance and stuff. My recommendation is go with QuickBooks, unless you're going to be very diligent in putting your things in Excel and keeping track of everything, so that like you're able to have an updated balance sheet, an updated income statement, and that. So here is a sample QuickBooks. So Excel, fine, definitely. Again, if you're choosing QuickBooks, it's not free. QuickBooks has its monthly subscription. There is an app called Wave Apps. I don't like using it. Yeah, the thing is, QuickBooks is weird. Okay, I love it, but like I've told them that like the price you see on the website is different from the price here. Is different. Like, it's weird. So I really don't. They are the best software I've used in terms of like, I like how they put sales taxes. I like how they do all of that, but sometimes it's just too expensive for smaller businesses. You're able to, when you get into QuickBooks, you're able to link your bank account. This is a demo file. You're able to link your bank account and have, first of all, it should be your corporate bank account, not your personal account that you're using to do business transactions.
Yes.
Have a separate business bank account, a separate business credit card account, ideally. Third account, I would like you guys to set up a business savings account. So you're putting money aside for the tax man. And if you want to create another savings account for something, go ahead and do that. But ideally have 3 accounts: your business checking, business savings, where you're putting your tax money, and the business credit card account where you're putting through all of your business expenses. Those accounts can all be linked to QuickBooks. And then this is what it does. It pulls in those transactions. So when you go and you buy gas, you buy all the categories that Tanya showed you guys already, QuickBooks connected to your online banking pulls in those transactions and puts them on this list. At least if it's here, now your only challenge is, either I don't know what this is, how do I connect it? That's a simple problem to solve. We just need to come here and then you can set up rules, you can set up. So this categories here, let me just show something. This categories here, this is what we call the chart of accounts. And this is different for different businesses, but in essence, it is the same thing, because we need to see income, we need to see expenses, we need to see bank accounts. Like in essence, is the same thing. So it's like, what are the kinds of expenses that can be deducted by a travel nurse, for example? And there are lots of questions people ask, like, can I do this for business? Can I not? Let me give you a premise. 3 things. For an expense to be a business expense, you need to think about, is this ordinary in my business? Is this necessary for my business? And is it reasonable for my business? If you think through that framework, it's easy for you to know what is a business expense and what is not. It's not always going to be right, but at least it gives you a framework to think, is it ordinary for my business? Is it necessary for my business? And is it reasonable for my business? For example, I'm an accountant, but part of what I do content creation. So I will buy a ring light, I will buy a camera, I will buy things like that. Those are not regular accountant expenses. But in my business, it is an ordinary expense for me because I do content creation. And so ring lights, cameras, and all of that become ordinary expenses for me. If you as a travel nurse come to an accountant and you don't know the framework to provide to us, if I see a camera expense in a travel nurse's account, I'm going to put that as personal. Unless you tell me, part of my business, I'm going to give a wild example. I have a YouTube channel where I educate nurses about how to become travel nurses. And it's part of my thing I do. And so I need to have this and this and this. Now you have related those expenses to the business that you do. But I would never have guessed that as your accountant if you do not have that framework to have that conversation with me. So I know that you know that this is a business expense. So have that framework. Is it ordinary in my business? Is it necessary for my business? And is it reasonable? I'm not going to buy, the kind of cameras they use on CNN and say that's what I need. No, I don't need that. I'm not a video producer. I'm not a cinematographer or something. That's extreme. So it has to be reasonable as well. Now, that said, these categories you have in your QuickBooks depend on those different categories that are ordinary, relevant, and reasonable businesses in your business, in your expenses, in addition to whatever Tanya already gave you guys. So what she gave is a guideline, which would, like I explained, it's a guideline, right? But you have to know what you're doing. Now, for you guys, unless you have to do sales taxes, this would be inactive. And so when you come to QuickBooks and this is already pulling all those expenses you're putting through your business credit card, you get here, it's a matter of classifying it. Say, for example, I went to Supplies Depot, and who is the name of that supplier? It might have been already called Supplies Depot in here. Perfect. What is this? It was an office supply. Okay, the office expenses, if that's the category it's supposed to go to. There's no taxes here. I'm going to put in a memo. I bought something. I'm just typing whatever there. I bought pencils for something, forget what I'm typing there. And then you do, so this makes sense to you based on what the bank pulled in, you do add. What this does is, it's forcing me to put sales taxes because the sales taxes are assigned here, but let me just put exempt in this case. And once I add, what I have done is I have taken that transaction from my banking, I've put it into QuickBooks. It's going to the expense line that it relates to, and it's updating my income statement at the same time, and it's updating my balance sheet because the balance on my credit card is going to reflect already that that amount came out of my credit card. So I love QuickBooks because it does all of those things, and plus when we can reconcile within QuickBooks directly, we can there's a way to have this QuickBooks pulling your physical bank statement into QuickBooks so that we have that already. And so it just makes it easier for everybody who's involved in doing your books. But all of that organization is only possible if, number one, you are keeping a separate bank account and a separate credit card and a separate savings account only for your business, and you're not using your, like, oh, I forgot today and I bought gas on my personal credit card, so can I connect that? No, it just complicates things. The least you can do is remember which credit card to use when you go to the gas station. That way, with this connection, everything gets pulled into QuickBooks the right way, and then the questions we're asking are all related to what we see. Or if you want to learn how to do the bookkeeping yourself, then that becomes a different element to it, which is like, now you're coming for training, we train you, and then we see you at the end of a month or at the end of 3 months or whatever, to have that conversation, to just review your things, and then come year end, we also do that. So this is just like to answer the question that somebody asked, like, how do I categorize my expenses? It's a combination of things. Personally, I love QuickBooks. It seems like Tanya too loves QuickBooks. But what is free is Wave Apps, which I don't like, but it's free. It doesn't create a balance sheet. Excel is free, could be complicated. It's up to you. You need to register for payroll account under your corporation with CRA. Yes. So yeah, you need to register, and completely agree. So I've seen people who did not register, got money out of their company towards the end of the year. It's like, when we are sitting and doing these assessments, like, you have to declare dividends, and you have to declare this amount of salary, and you have to declare this amount of dividends, and the account wasn't opened. So we created the account at the time and then did the payments. But so long as it is before January 15th of the following year, you technically are not late. And I'm doing all of this air quotes because, like, there's always a way to work things out, right? But if it goes beyond, now it's like, well, you're late. Like, how can we justify that you paid the salary for 2023, but you didn't remit the taxes by January 15th of 2024. That's what I was saying. Like, those who are, like, now it's already late for those who should have done that, but you still need to do it, because if you have to indicate that you made a salary for other tax and financial purposes, you need to show that you made an income in 2023. So you might as well do it and then be late and pay the penalty. And the penalty is like, I think it's like 10% of what you owed. It's not a small amount.
When you owe the government, right?
Sorry?
You pay charges when you owe the government, but if they owe you, you don't pay charges.
If they owe you, you don't pay. If they owe you and you had filed on time, then they will pay you interest on what they owed you. But if you filed late and they owed you, then you're giving them free money. I've seen people who say, either I'm not going to pay installments, I'll pay the penalty, because I'm not about to give the government free money. I'm not about to lend them money to use tax-free and then they pay me back. So people make that choice, but we will always let you know you have to do installments. This is how much your installment is going to be. If they owe you, they will pay you back. Or, like, we explain all of that, and you get to make your decision. Like, you have to be able to make your decisions. Our goal is to get you to make informed decisions about your own finances. If you love this video, check out this one right here next to me. I think you'll love it.